Off to the races again for stock futures, sharply higher open. Thanks in this time to chip stocks in a rally and a big gain in China again, third straight gain for China stocks. Let's talk from technicals. Join us now, Katie Stockton, Fairlead Strategies founder and managing partner, as well as a CNBC contributor. We got the 50 basis points, Katie. This move today. That's already in the rearview mirror. That's why I guess why it's called news. This has to, and you don't care about fundamentals, but this has to do with what Micron said about demand. But this does, for whatever reason, it gives maybe some underlying strength to where the averages are, the SPX specifically.
That's right. So the S&P 500 did ultimately confirm a breakout to new highs, and that the former resistance was right around 5670. The breakout can allow for a measured move projection of about 5935. So it does act as a positive technical catalyst. Our recommendation has been not to chase a rally, and we stand by that today, even with strength carrying over from Micron to broader technology stocks. We feel that the risk reward isn't great when you look at the spread between resistance and support levels. For the S&P 500, supports are just shy of 5,400 at this time, so that feels a little bit uncomfortable to us. And if you look at the Chinese stock market, the indices there have actually major breakouts from basing phases, and that is a bullish long-term development for China. But we do also, at the same time, on a short-term basis, have new counter-trend signals. The Hang Seng Index, for one, as of today, has a new counter-trend signal from the DeMark indicators. And that would suggest that we can be patient and wait to add exposure or pull back to take advantage of it.
In terms of how we view the market and whether we're complacent or not, Kate, we're in such a different place than we were, if you recall, in 2022 and 2023, when everybody on Wall Street was looking for a retest of the lows of 3,500. Mike Wilson, I think, was down at 3,000 with a worst-case scenario. We've almost doubled. Yeah. We never retested. There's a guy named Kantrowitz at Piper. He's like 30 years old. He told me, I just know that the earnings are going to be, it's just obvious that he was at like 3,000. Now, every day that it goes up, no one says boo. It's like, yeah, we're up again, headed to 6,000. How did that happen? And you didn't turn bullish. You didn't turn bullish for a long time either, Katie. You stuck way too long with the retest.
I did. Yeah. We just don't like to stay wrong for too long, right? And the uptrend is obviously very, very strong. It has momentum, but it also has breadth, right? The participation has been very good. So, of course, as a technical analyst, it's been really difficult to feel bearish at all, right? We do have the yield curve having uninverted. And when you look over history, that's not a great thing, as you know, for the stock market nor the economy. So we feel that there are risks here, and there are risks in the charts that we haven't seen since about 2021, ahead of the bear market cycle. So from a longer term perspective, we're somewhat cautious. We're not looking for a bear cycle, but rather maybe more of a range bound environment based on the longer term counter trend signals that we do see. Sideways markets are among the toughest to take advantage of. The rotations become really important if you're trying to generate any alpha in that type of environment, because you can't just buy and hold and benefit from the uptrend in the way that we have done recently.
I can give you like so many reasons to sort of feel uncomfortable fundamentally, whether it's the recent consumer confidence number or even the Fed. I know the Fed says don't read anything into a 50 basis point cut, but it still makes me think that the labor market could deteriorate more quickly than people are thinking right now. I don't know how you feel about that, but I would not annualize this return where we are right now in the S&P and say we're going to be up 35% for the year. I do not. Do you think that's going to happen? We already had the rate cut.
This is the time of year, of course, where people start to think about the next year and returns for the next year. And I would say mid-single digits seems pretty realistic based on what I'm seeing. So not at all a year like this year. And I think a lot of that comes from the increased volatility perhaps associated with some of those things that you highlight there. The increased volatility is still here. The VIX is above the 200-day moving average, which has shifted gradually to the upside. And that's just one indication that we're in this higher volatility cycle. And that, again, doesn't tend to be market positive long term. We'll just see more volatility from more of an intermediate term perspective, maybe 2 months up, 2 months down, that type of thing. So I think it'll be a pretty difficult tape, and that we have to, in that environment, become a little bit more short term in our positioning to succeed.
If you had to look at one canary in the coal mine, I mean, if crude got below 64, you talk about that support. And then I don't know, is the bond market, what if long rates continue to stay high even after we get these what would be something that would signal trouble to you for equities? The Russell looks good.
I think we already have that, honestly, if you go back and look at the rate cuts, right? I feel like we have that more from a macro perspective. From a macro technical perspective, it is all about rates, and I guess secondarily maybe about NVIDIA. NVIDIA has a triangle formation on its chart that it should be testing the upper boundary of it today with Micron's news. So we have a real proof point for NVIDIA. The triangles tend to give way to increased volatility. They just don't give you an idea of which direction that's going to come in. So if we see NVIDIA break out to the upside from its triangle formation, that is something that would be market positive. And of course, conversely, if we see a breakdown, that would be market negative.
Okay. All right, Katie Stockton. You don't sound very sanguine right now to me. I've known you a long time. I don't, you don't want to say it, but you're not pounding the table on
No, I feel like the market is not going to lend itself to easy returns at this time.